Hi, I'm Pattu from freefundcal.com and welcome to Mutual Fund FAQ, where we discuss some of the basic questions that new investors have on mutual funds. So this time let's talk about what should be my first equity mutual fund. Now, before you ask that question, which is the right question to ask, there are some things that you have to get clear and work on. What is your financial goal? And for that financial goal, how much should you invest? How much are you going to put into equity as a mutual fund? How much are you going to put into fixed income or any other asset classes? But typically, these two asset classes will do. So you must be clear about those aspects, clear about your asset allocation, how much equity, how much fixed income, what is your goal, how much you're going to invest for it, when you need the money, what is your return expectation. After you do all that, then and only then you ask, what should be my first equity mutual fund? Now, this is a tough question to answer because it depends on your approach to volatility. People who have not seen ups and downs in their investment value will have a very difficult time choosing their first mutual fund. So I can only give you product names based on what kind of an investor you are. If you say that I don't care about ups and downs, I understand that I need to take a good amount of risk to try and get good returns, I will learn how to manage this risk as I start investing. So tell me a high risk, potentially high reward option. Then the simplest choice is ICICI Nifty Next 50 Direct Plan Growth Option. That's it. Just do it. Simple index fund. You don't have to worry about anything. You don't have to worry about fund manager performance. You just need to learn how to manage the risk associated with that by looking at your asset allocation every year, rebalancing your portfolio. I have videos on that. You can look at it. And changing your equity allocation as your goal deadline approaches. So that's one option. The second option is you say, I like good returns, but I don't like too much ups and downs daily. That kind of thing will make me nervous and agitated. So give me a managed mutual fund which will reduce day-to-day volatility. Maybe if it gives me a little less returns because of that, it's okay with me. If you are that kind of an investor, then I'll give you two options. One is Quantum Long-Term Equity Value Fund. I think that's the new name. That is an actively managed equity fund. It can pick stocks from the top 200 in terms of market capitalization. And if they do not find stocks at the right price to buy, according to their calculations, they will hold 20 to 25% cash and only buy when such stocks are available. So which means that there will be periods when the fund will underperform its benchmarks, Sensex, but it will not fall too much. So the downside protection will be reasonable with Quantum Long-Term Equity. You can choose that and it will give you reasonable returns. It should beat Sensex. It has bet the Sensex and I think it will continue to do it. I expect it to do it in the near future too. So that's one option. The other option is you buy a mutual fund that invests in a balance in a mix of equity and fixed income. 65% above in equity, 65 to 75%, maximum 80 in equity, rest in bonds. So it will rebalance this portfolio every month. So you will get a little bit of risk management there. One such fund is the HDFC Balanced Fund. Its new name is HDFC Hybrid. I think HDFC Equity Hybrid Fund. You can consider that as two options. So Quantum Long-Term Equity and HDFC Hybrid or the old HDFC Balanced as two options which are risk managed and reasonable returns. So the first option was high risk, potentially high reward, Nifty Next 50. It has given high reward in the past. I'm not sure about the future, but you'll have to take a call. So the first is high risk, high reward. Second is lower risk, reasonable reward. And the third is you say that I cannot handle any kind of volatility. I mean, even the volatility with those quantum and HDFC hybrid fund, that kind of volatility is too much for me. I cannot handle that. I will sacrifice on the returns. Doesn't matter. Little bit over fixed deposits. Let's say if 8% is the inflation of the fixed deposit rate, little bit over that is okay for me. But volatility should be minimum. Then I would suggest that you go for a dynamic asset allocation fund like Motilal Oswal dynamic equity fund. So that uses a factor called the MOVI, that is, it takes the Nifty PE, dividend yield, and price to book value, combines these and creates a factor. So depending on how much that factor is, it will change its equity allocation from high to low. I have a detailed post on what that movie is, but this is its volatility will be quite low. Its return will also be lower, so you cannot have your cake and eat it too. So these are three options I'll give for investors looking for their first equity mutual fund. So you have to be clear about what your temperament is. Of course, it's not always easy, because if you have not seen big dips, you cannot define your temperament. So you have to go, take it as things come. But if you can handle the volatility, the best way to handle volatility is not to look at the portfolio every day. Look at it only once in a while. So if you're that kind of guy, I don't want that. I'll wait. It doesn't matter. Then choose the Nifty Next 50 index fund. If you want better daily managed risk, choose HDFC hybrid equity fund or the quantum long-term equity fund. If you want very little risk, there will be risk. It's not as if there won't be. The daily price fluctuations will be much lower than the other funds, but the return will also be correspondingly lower. Then you can choose Motilal Oswal dynamic equity fund. So those are three categories that I can suggest. Of course, there are more, and there are the types of investors are also more, but that's something to start with. So catch you later.